Hi everyone, my name is Bakhtiar. Today topic sale of business property. Chapter 7, Learn Objective 7.5, page 720-26. We have sale of 1231 assets. We have recapture provisions and conclusion. What is 1231 assets? This is land or depreciable property, land, equipment, machinery, intangible assets, used in a trade or business for making money, profit, long-term assets, used for longer than 12 months. If all those three criteria are met, the asset fell under 1231 section. What happens if that 1231 asset is sold? If there is a loss, it's ordinary loss. If there is a gain, we have to consider recapture provisions. We'll talk about it later on. From the chapter 6, we remember that gain occurs when the sale price is higher than adjusted base, and the loss occurs when the sale price is lower than adjusted base. Let's look at recapture provisions. Depreciation, income tax deduction that permits to cover the cost of assets used in a trade or business. Longer used, more cost is recovered, less income tax is paid, because more depreciation deduction is taken as allowable deductions. When 1231 asset is sold, if there is a gain, the gain can qualify for capital gain tax preference. It means that the gain can be taxed at a lower rate than ordinary income. IRS says that if taxpayer was allowed to reduce taxable income by taking depreciation deduction during usage of property and paid less in taxes, then when property is sold, some of that gain attributable to depreciation deductions should be taxed at regular rates. This is called depreciation recapture. So let's go back and look at the sale of 1231 assets. As we said, if there is a loss, it's ordinary loss. It will be always. If there is a gain, we have to look at the type of the asset sold. If it's a personal property used for business or trade, equipment, machinery, furniture, then it falls under the 1245 recapture provision. And this provision says that gain attributable to depreciation is taxed as ordinary income. If the asset sold is real property used for business or trade, like buildings, residential, non-residential, then it falls under 1250 recapture provisions, and that provision says that gain attributable to depreciation is taxed at 25%. If anything left after 1245 and 1250 recapture provisions, then remaining balance is taxed as a capital gain at 0%, 15%, 20%, depending on taxable income and filing status of taxpayer. Let's look at the example. In June 2021, company XYZ bought furniture for office use for 20,000, used mattress and healthier convention, and sold that furniture for 15,000 on May 2023. So we have to first calculate the depreciation. We see that this is a furniture, this is the 7-year class life, healthier convention. Then looking at macros table, we find the rates and we calculate the depreciation. The total depreciation calculated is 9,505. Only please remind that depreciation for the year of disposal, we are taking half of that rate. Adjusted basis calculated, this is the total depreciation. Adjusted basis calculated by deducting purchase price minus depreciation. We come up to 10,495. 495. We calculate realized gain by subtracting adjusted base from the sale price from 25,000. It give us 14,505. So we have the realized gain of 14,505. We look at the assets sold. This is furniture. This is personal property. It falls under 1245 recapture, which says that part of the gain to extent of the depreciation should be taxed at the ordinary income. The remaining balance will be treated as a 1231 gain. So we have 9,505 equal to recovered cost as ordinary income, and the rest is a 5,000 as a 1231 gain. What if sale price is 16,500? Having adjusted base of 10,495, we will have released gain of $6,005. And as it's less than depreciation deductions of 9,505, then full amount of the $6,005 will be treated as ordinary income. Let's look at another example. In February 2022, James LLC bought a building for business for $230,000, 100% usage for business, 39-year property. In December 2024, James LLC sold the building for $212,000. Taxpayer at the 35 tax bracket, not subject of surtax, and adding this gain will not increase to next bracket. Same approach as a previously solved example. We have to calculate depreciation first. This is the building, straight line depreciation, 39-year class life, mid-mount convention. So if you look at the table, we will see that we have those rates, and we come up to the total depreciation of 16,717, and adjusted basic calculating by purchase price minus depreciations, it give up to $213,283, and the released gain is a sale price minus adjusted base. It will be 26,717, and we look at the type of the asset. This is the building. So real property, it fell under the 1250 recapture provision, and this recapture provision says that part of the gain attributable to depreciation should be taxed at 25% rate. So we have here 16,717 as a tax at the 25% rate, and the rest, remaining balance 10,000, treated as a 1231 gain. On January 18, 2019, the final IRC 199A regulation were issued on the gain and loss as a qualified business income. From that day on, any gain and loss, short or long term, will not be considered for calculation of qualified business income. However, if any item is not treated as a capital, such as 1245 recapture provision for personal property to extent of the depreciation amount, which will treat it as ordinary income, then that part of ordinary income will be included in qualified business income calculation. Let's look at example. On June 4, 2024, company sold office equipment for $18,000, which was purchased on October 10, 2022 for $22,000. The accumulated depreciation total cost of recovery is, as of sale of date, is $9,505. We have adjusted base of 12,495 and we have a released gain of 5,505. As released gains are less than total cost of recovery, then full amount will be treated as ordinary income. Then this ordinary income will be added to calculation of qualified business income for the form 8995. So assuming that taxable income in Schedule C we have 15,000, 1/2 self-employment tax paid is 2,100, then total qualified business income will be 53,405. Just don't forget that ordinary income as 1245 recapture provision is a part of qualified business income calculation. In conclusion, what I take from this presentation is 1231 assets a land, depreciable property, used for the business or trade, holding for more than 12 months. If this asset is sold, if there is a loss, it's always treated as an ordinary loss. If there is a gain, we have to look at the type of the asset sold. Personal property, gain to extent of depreciation will be treated as an ordinary income, 1245 recapture provision, and the remaining balance as a 1231 gain. If it's a real property, gain to extent of depreciation will be taxed at 25%, requirement of the 1250 recapture provision, and remaining will be treated as a 1231 gain. If the asset sold is a land, full amount is a 1231 gain, as a land is not depreciable asset, so there is no 1250 recapture provisions. The part of the gain which is treated as ordinary income to extent of depreciation for personal property is a part of qualified business income calculation. This is today's presentation. I will appreciate for any comments. Thank you for watching and have a great weekend.